Back in February of this year, I released a video entitled Utility versus Store of Value. If you missed it, you can do a YouTube search and find the video. I'll also place a link in the description of this video. But in my video, Utility versus Store of Value, I discussed some of the things that the wealthy buy to store their wealth. I talked about this Harrington commode, which sold at auction for $5.9 million, and a few bottles of Chateau Lafite Rothschild wine, which sold at auction for $700,000. The wealthy buy items like these, not for their utility. After all, if they wanted to have a chest of drawers or a bottle of wine, there are much cheaper items that they could buy that actually have higher levels of utility. No, they buy these items because they serve as reliable ways to preserve wealth when financial assets fail. It's not their utility that makes them valuable. It's their quality, their uniqueness. And the rich know this secret, that usefulness and value are two very different things. The rich buy these things because they are expensive and have a track record of appreciating in value over time. These items have a quality that we call salience. Can common people afford items of comparable quality? Not easily. It's out of our reach. There really is only one item that we common people can buy for now that is of the exact same quality as what the rich will buy for wealth preservation, and that item is gold. And the rich do hold it. There are 5.5 billion ounces of above-ground stock of gold, and only 1 billion ounces of it is in central bank vaults. The rest of it, what is not in jewelry form, is in the hands of the wealthy families of the world over. But does it appreciate in value over time? As I showed in parts 1 and 2 of this video series, yes it does. And it doesn't have to be lent out in order to do so. But unlike rich family trusts, which can hold gold for an eternity, you and I have a finite time horizon. And so, we need to be conscious of when it is a good time to buy and hold gold, and when it is a good time to seek other means of preserving our wealth. This will be the last video in my 3-part series titled Good Money Appreciates. In it, I will show you how to decide when to accumulate gold as a long-term wealth holding and what you should expect. So let's go back to this slide that I presented in part 2. I showed how over a century and a half, the amount of various items gold could purchase has increased. Today, gold can buy 10 times as much wheat as it could in 1876. It can buy 6 times as much cotton. It can buy 5 times as much silver, and it can buy almost twice the amount of oil. Thus, gold has increased in purchasing power significantly over time. The annual rate of appreciation is between 1 and 2% per year for most items. And we're talking about an appreciation in real purchasing power, not nominal purchasing power. As I showed, since the year 1971, the dollar has depreciated in purchasing power by 3 to 5% per year. So if one wants to use dollars to just break even in purchasing power after the government takes its cut in the form of taxes, one must lend those dollars out at an interest rate of 5 to 7%. Even then, a person's wealth won't be growing. To make matters worse, the person who has lent the money might never get it back. Contrast this against humble gold, which simply sits there, getting a little bit more valuable each and every year in terms of the things that it can buy. Note, though, that gold has not appreciated in a straight line. There have been decades when it has done quite well, and decades when it has done quite poorly. Of course, wealthy families don't have any intention of selling their gold. They don't have to. The gold is there for future generations, and so it just appreciates in value to the benefit of the family that holds it. So the wealthy families don't need to worry about the fluctuations in gold's value. Much like fine art, fine furniture, and fine wine, it just sits there, tightly held, appreciating in value. You and I, on the other hand, might care a great deal when gold's value rises and falls. Though I would like to caution you that too often we see the dollar price of gold rise and fall, and we get excited or worried unnecessarily. It is the purchasing power of the gold that we should care about. So how does one know when gold is a good item to hold, or when it's best to seek other ways to preserve wealth? How does one avoid buying gold only to watch as its purchasing power declines? Let's explore that question. I presented a chart like this one in many of my previous videos, though I never took it back all the way to 1876. It's a plot of the gold versus oil ratio, and it's my favorite metric for valuing gold. What makes the gold to oil ratio special? Well, oil is the most important commodity in the world. It is the beginning of the food chain for the production of almost all goods and services. And gold tracks its price very well over time. Notice how the data series seems to bounce between two extremes, and that it's almost trendless over long periods of time. Thus, the data series has a property known as mean reversion, which makes it very useful for measuring relative value. Let's see how it works. I've drawn several colored lines on the chart showing the various extremes of the ratio. I put a dark green line at a ratio of 10. Anywhere below this line means that an ounce of gold will purchase less than 10 barrels of oil. This has not happened very often in history, but when it has, as happened around the year 2000, gold can be viewed as being very, very cheap relative to oil. I put a red line at 25. Anywhere above this line, an ounce of gold will buy more than 25 barrels of oil. There have been a few instances in history when gold would buy this much oil, but the high gold value relative to oil has usually been short-lived. Most of the time, gold will buy somewhere between 10 to 25 barrels of oil. This is its general range. Towards the bottom of the range, where it is now, we can consider gold to be fairly cheap relative to oil. And towards the top of the range, we can consider gold to be fairly expensive relative to oil. But can this be used as a metric to test whether gold will appreciate or depreciate in purchasing power compared to other items? Let's take this analysis one step further. Let's highlight some extremes in the gold to oil ratio and see what happened during the in-between periods. From this chart, it would look like 1876, 1920, 1975, and 2005 were very good times to accumulate gold for the long term. After all, it was very cheap relative to oil. We might also expect that the years 1892, 1933, and 1988 were very poor times to hold gold because it was expensive. So let's mark these years in our minds and go back to the original chart of gold's purchasing power to see what happened in several windows of time. So here's our chart with the times of extreme gold valuation marked off. Remember, long term, gold has appreciated in purchasing power relative to oil by about 0.5% per year, silver by 1.3% per year, cotton by 1.4% per year, and wheat by 1.8% per year. This is the appreciation that our rich families will realize long term via their family trusts. Let's use these rates to benchmark against gold's performance over shorter periods of time. If an individual owned gold starting in the year 1876, when it was cheap, and held for the subsequent 16 years, then our gold holder would have seen gold appreciate relative to oil by 10% per year, against silver by 1.8% per year, against cotton by 1% per year, and against wheat by 3.3% per year. This is a fairly respectable rate of increase in purchasing power. Contrast this against the subsequent period starting from a high gold valuation where gold lost 5.6% per year against oil, 0.3% per year against silver, 2% per year against cotton, and 3.5% per year against wheat. During the period of time starting when gold was cheap relative to oil, gold appreciated in real purchasing power by a few percent per year. A gold buyer who bought when gold was expensive, on the other hand, lost several percent a year in real purchasing power. Let's take a look at the next couple periods of time. So what did we see during the Roaring '20s leading into the first few years of the Great Depression? Well, gold started out cheap relative to oil, so we'd expect it to appreciate in real purchasing power. And it did. Against oil, it appreciated an amazing 14.5% per year. Against silver, it appreciated a hefty 10.6% per year. Against cotton and wheat, it rose in value 5.4 and 9.2% per year, respectively. So gold increased in real purchasing power a great deal over those 13 years. And all the buyer had to do was buy it, hold it, and wait. The 20s were considered to be an exceptional time for stock owners, but I wonder if they ever benchmarked their performance against the roughly 10% per year real gains in gold's purchasing power, especially after they experienced the first few years of the Great Depression. Of course, all good things do come to an end. 1933 to 1975 was a period of relative stagnation for gold. It lost a couple of percent per year against silver and oil, but it was able to purchase about 0.5% more every year of cotton and wheat. There was no harm in owning gold over this period, though there were certainly some missed opportunities for those who did. 1933 would have been a great time to sell some gold and buy some depressed stocks. So let's look at the next time period. It's really the same story all over again. Owning gold starting in 1975 was a very good position to be in. For the following 13 years, gold appreciated in purchasing power by from 6 to 8% relative to oil, cotton, and wheat, and by about 5% per year against silver. And starting in the next time period, when gold began as expensive relative to oil, we can see that though it corrected in terms of oil by a hefty 7.2% per year, its purchasing power remained relatively constant compared to silver, and it actually appreciated relative to cotton and wheat by 0.5% to 1% per year. So we have seen that using the gold to oil ratio does a very good job at predicting good times to own gold. Let's take a look at some recent history. 2005 was a good year to accumulate gold according to the gold to oil ratio. And though the story has not yet completely unfolded, we can see how the gold holder fared since then. Gold has appreciated against all of the listed commodities by 4.5% to 6% per year. This is a very respectable performance in real terms for a chunk of yellow metal that has no utility and just sits there. But as I noted, the story has not yet completely unfolded. Gold has not yet become expensive relative to oil. In fact, the gold to oil ratio still sits at the low end of the range at 13. The past 3 years that the community has been fretting about, well, that's just the last little squiggle on this graph. So don't fret. Gold has not really seen the majority of its move yet from the start of the bull market in 2005 when the gold to oil ratio was a little under 10. The time to be concerned is when gold buys more than 25 barrels of oil. Which brings us to our conclusion slide. So to conclude this series, I'd like to make some remarks. First, I hope that you've become convinced that good money doesn't have to be lent in order to appreciate in value. A good, non-inflated money will enjoy some of the benefits of productivity improvements in society. Bad money, by contrast, depreciates in value unless you lend it out. And when you do lend it out, not only are you giving some of your benefits to the government via taxation, but you are also taking the risk of total loss. Next, I'd like to make the point that both gold and silver have been very good money to hold over the past century and a half. Gold, however, has been the better money because it's appreciated long term by 1 to 2% per year in real purchasing power. Silver has maintained its purchasing power relative to agricultural commodities. In fact, it has appreciated a little bit. Nevertheless, it has lost purchasing power relative to gold and oil. This is a long-term trend that has unfolded over 140 years. Will it reverse itself? I don't know. It could, but it will require that a general population start treating it more like money than like a commodity. I've shown you that although the very long-term holder of gold has seen a general increase in its value, the shorter-term holder needs to be careful. It's best to buy it when it's cheap and find something else to buy when it's expensive. And we can determine when it's cheap or expensive by looking at the gold to oil ratio. When gold buys less than 15 barrels of oil, it has typically appreciated by between 5 and 10% per year in real purchasing power over the following decade or more. When it buys more than 25 barrels of oil, it has typically lost purchasing power, usually by a small percentage, but sometimes more. Gold is still in the early phases of appreciation as far as I know. It can buy 13 barrels of oil, which is much more expensive than in 2005 when it could only buy 8, but still a far cry from where it will be at the end of its appreciation phase. Finally, to conclude, I'd like to restate what I know to be true. A saver can do very well. It doesn't take much effort. All one needs to do is choose the right money, hold it, and wait.